You know, January is a crucial month, Eva, for the markets, mainly because it is used by many analysts as an indicator of Wall Street's behavior for the rest of the year. And while many market watchers have been largely pessimistic about this past January, technician David Holt saw some silver lining in the month. I mean, confusion is the word. If you ask people just generally, how do you think January was? They'd probably figure it was a down month. It was not.
Now, perception-wise is the problem. In reality, January was a very nice, productive month. You had prices up, you had volume increasing, expanding, you had good participation.
That 140-point down day we had that one Friday didn't help, did it?
You had one of those days, you may remember, we had one clear, kind of frightening down day every week for the last 8 weeks.
There would be a 50-point down day, a 70-point down day, but we always recoup those losses. We look at some of these statistics regarding the month of January. 80% of the trading days were up on the New York Exchange.
There's 20 trading days in a month. 16 of the 20 prices actually gained in value.
And advances were over the declines 70% of those times.
Yes.
You know, today it was a good example. We're down 13 points on the Dow, but the advances still led the declines by a slim margin on the big board.
See, that's very important, Bill, as you know, because you can have rising prices and have a few story talks taking it up. And this was very broad increase in price. So a lot of issues were chipping in their little quarter here, 3/8 there on a gain basis, and so you have broad participation, which gives a very good platform.
A few of the other statistics, volume on the big board was up for the month, a net increase of 3%, over the 6% from 12, from the lows that we saw. It was 6% from the December 4 lows, and the average stock was up over 17%. Is that right?
The average stock is over 17% from the December low on the New York Stock Exchange.
That's amazing.
And that's real price gains.
That's amazing. So we really did have a good month. Now, does that necessarily mean that we're going to have a good year so far?
Historically, they say that that's true, but that's kind of like the winner of the Super Bowl game, the hymn lines, and any other indicator. What I really think it means, Bill, is that the people who are willing to come into this market are coming in with pretty firm commitments. And each of those big sharp down days that we had, the ownership of those shares changed from weaker hands to stronger hands, because even though the traders who are in there short term are very nervous, they won't leave anything on the table more than a few days. So they're pulling all those off. The stock is being accumulated by somebody, and I think this longer term people who are getting a little bit more confident, still not all of the cards in the deck, but what they are committing is very constructive.
It's been 3 months since the crash. Premium levels have come down on the options market. We are seeing psychology improve a bit. Do you think it's too soon? Would you be skeptical of this improvement in the investment psychology of the markets?
I would be skeptical if somebody was saying to me we're ready to launch a monstrous rally in the overall market. We don't have that much of the healing process behind us. But when you see the things that people worry about, the dollar apparently has stabilized short term. Interest rates are coming down short term. The economy, it may be struggling, but we don't see a huge depression on hand. All these things, I think, are giving us the kind of confidence building we need, slow but sure.
And maybe that's the best way to do it, huh?
Absolutely.
Yeah. Thanks, David. We'll see you next week.
Okay.
David Holt, Director of Technical Research at Morgan Olmsted Kennedy Gardner, based in Los Angeles. Dave joins us, by the way, every Monday evening here on America's Business to Chart the Market. And coming up next, Eva Dorn will talk with commodities trader William Kaiser and take your phone calls on the various commodities as well. Stay with us.
Yeah, I'd like to buy this $1,200 computer.
That'll be $5,300 complete.
$5,300?
What with monitor, software, disk drive,
etc., etc., etc. Oh. How much is that $1,000 computer?
$4,400.
Uh-huh. How much is that $1,400 computer?
$3,900.
No, Max. The $1,400 is $4,800. The $600 is $3,900.
I thought the $1,100 was $4,800 and the $500 was $3,900.
You stand corrected.
Some computer companies give you a lot of options. K-Pro gives you a complete computer from $11.95. For your nearest dealer, call 1-800-4-K-Pro.
From Oberweis Securities, Catching Winners Early, a weekly program devoted to emerging growth stocks and the investors who buy them. This week, the program highlights one of the small capitalization growth potential stocks that Jim Oberweis considers a winner. Learn how an experienced professional selects the stocks for his own model portfolio. Tune in Tuesday, 10:30 a.m. Eastern Time on this FNN channel for tips on how to improve your investment strategy on Catching Winners Early.
Financial News Network gives you continuous trading updates throughout the market hours. After the closing bell, Wall Street Final offers a complete wrap-up of all the action on the floor, plus special reports, breaking business news, and analysis of the top financial stories. So, when you look for the best in business news, don't miss the Wall Street Final every business day at 5 p.m. Eastern. You can keep an eye on your money with the Financial News Network.
Before the government gets hold of your tax return, maybe you should get hold of the Wall Street Journal. After all, it's your money. At least for the time being.
Call 800-638-1200 for this great journal subscription offer. 13 weeks for just $29.75 with a money-back guarantee. 13 weeks, $29.75. Phone 800-638-1200 now for the Wall Street Journal.
Program trading, where institutions try to lock in a profit when there's a disparity in price between a stock index and its corresponding futures contract, has been blamed by many for intensifying the market's decline on Black Monday. Yet today, the Commodities Futures Trading Commission said that their studies show that the combined trading strategies of index arbitrage and portfolio insurance selling did not cause the stock market collapse or intensify it. Joining us to discuss the CFTC's latest report is Bill Kaiser from Rosenthal & Company. He's also a commodity trading advisor with the Classic Trading Program. Bill can also discuss the general trends in futures prices and answer your questions on these markets: stock indices, bonds, energy, and precious metals. And Bill, you know, people out there must be thinking the CFTC is saying one thing while so many others are saying another, you know, notably the Brady Commission. What's your response to all of this?
Well, I think a lot of the liquidity that's actually added to a market is definitely added by the more contracts you traded, obviously. And when you get involved in the program trading, for everyone that's really buying, you've got someone else picking up the other side of the contract. What happened in the October 19th, I don't think anyone will really know the answer to it, but a lot of what happened is a vacuum below the market. Intensified selling obviously came in. Market was in an extreme overbought condition, so as much as the market went up, really, if you look at it for the whole year, we still had gains in it. But the market itself did have to go down to a certain level. You ran into margin problems all along the way. But the liquidity that was added by these programs, I think it's important to a certain extent. They all don't run on the same computers. So, you know, again, for everyone buying a contract, someone selling it, it was that temporary lack of liquidity that happened actually in a very short period of time that caused it.
So you are agreeing with the CFTC study, and of course they regulate the futures industry. You basically think that program trading was not to blame?
No, definitely not.
Somebody might be listening to this and thinking, do you think that's a little self-serving? You know, they make money when people trade futures contracts.
Well, I think it's important to provide the, well, you know, another thing too, let's just back up a second. The average speculator that was trading in the market was not very heavily into the S&P market. It's these larger institutions that are in it. The fact that they couldn't so-called lay off other ends of the trades in some other market, when you deal with the actual stock exchange itself, I'm not putting the blame over there, but the fact that you had no liquidity over there and certain stocks were closed, they were forced to come in our market to lay off a lot of their trades. So it was a combination of things that took place back then, and again, I don't think anyone will ever really know what went on then.
Now, as we all know, in order to reduce volatility, the New York Stock Exchange has instituted several programs. Some of the firms have stopped program trading in their own accounts. And yet today, again, the New York Mercantile Exchange came out and said we are lowering the margin requirement on our oil futures contract, and that would lead to more volatility, presumably. Isn't this a little bit of a contradiction in terms of, you know, what the markets are trying to do, trying to become more stable?
Well, I don't think I think just the opposite, really. Lowering the margins is going to attract more speculators into the market, and what that's going to do is give you better liquidity. And the more orders you have on both sides of the actual price, in other words, if a market is at $18, for example, in the oil market, and you've got a lot of orders underneath the market at the $17 area, and also a lot of orders above the market at the $19 area, that's going to give you your stability in the market. It's when you don't have orders, let's say, to buy all the way down to 15, and you've got them to sell right above the market, that's going to keep the stability out of the market. Lowering margins actually tracks more people into the market, and lower margins is really a function of the volatility of the market. The more the volatility arises in the market, the higher the margin requirements are going to be. So it's a function of price, percentage-wise, and also it's a function of the volatility in the market. And the fact that the oil market has basically been locked in a fairly tight trading range, there is not a lot of volatility in there compared to what we've seen.
So are they trying to get more business?
Definitely.
All right. We'll talk more about this when we come back. And I know you want to talk about the bonds, currencies, stock indices. We'll do that when we come back, and we'll be back to take your calls as well when America